Welcome to our outlook for the second half of the year. I'm Vivian, and I have here with me Steve Bryce, our Chief Investment Strategist. Welcome, Steve.
Thank you.
It is 6 months since you released the Outlook 2015 publication, a year to widen your investment horizons. Have things worked out as you expected?
I think largely yes. We did see a weakness in the US economy in the first quarter, once again surprising people. But if you look at the big picture, the US is still in recovery mode. The latest data on the jobs front is very supportive. Europe is also picking up, as is Japan. So the global economy does indeed seem to be expanding at a slightly faster pace, or likely to in the coming months. Inflation remains very low. That's allowing obviously interest rates to remain very low around the world. We've seen divergence in monetary policies coming through, with quantitative easing coming from Japan and Europe more recently, obviously at the beginning of the year. What we are waiting for is really when is the Fed going to start hiking interest rates. At the end of last year, we forecast that to happen in June. In February, we pushed that back to September, so we're still waiting for that. But that looks increasingly likely after the recent FOMC meeting a few days ago.
What about your views on which asset classes you expected to outperform in 2015?
Well, our three key convictions have performed pretty well. So if you look at global equities, was our number one conviction. That's generated significantly positive returns, as has the diversified income allocation that we also recommended at the end of last year. And that the third theme of alternative strategies has generated low single-digit returns, but still helped diversify portfolios. If you look at more granular level, again, things look pretty good. So equities, US equities did well at the start of the year, but Europe and Japanese equities have done very well. So that's really helped us, and we recommended people do invest in those equity markets on a currency hedge basis, and that also worked. So overall, things have worked well. Not as always, not everything works out perfectly, but on balance, it's been pretty good for us so far.
What is your outlook for the second half of the year?
Well, we're going into the second half of the year with the same three conviction themes. So still global equities, diversified income, and alternative strategies. So nothing's changed from that perspective. And that's just because of our macro view hasn't really changed. The only thing we would say is we are entering what we believe will be a quite volatile period. There's three real risks out there at the moment that we see as being quite concerning. Obviously, the first front and centre is Greece. So we believe that the risk of a Greece defaulting is quite high now, whereas that was not something we were too focused on at the end of last year. We don't believe that leads to Grexit, but obviously if Greece does default as part of a bargaining tool, that could lead to significant volatility. We're also approaching the first Fed rate hike in September, in our opinion. Again, historically, after the first Fed rate hike, you usually see some market volatility coming through. And one much less talked about issue is El Nino, which could have impact on the emerging markets, positive for some, but also negative for others. So those are the sort of three risks out there. So that could lead to some volatility over the next 2 to 3 months. Longer term, we still believe that the outlook is positive for equities and diversified income, but we need to navigate this volatility first.
How would you advise investors to navigate this environment?
Well, I suppose that's the key question. So in terms of looking at the big picture, we're still bullish on global equities on a 12 to 24-month basis. Therefore, any weakness in equities we see could be a good buying opportunity in our view. Within an income portfolio, the way we've sort of changed our allocation last month, and we reiterate this month, is we're dialing back the risk a little bit. So we still like equities, so we don't want to totally get rid of our equity exposure, but we prefer to take some of that through a covered call strategy. So to generate some yield in the short term and maybe offset any losses in the short term as well. We also like leveraged loans, so again, reducing interest rate risk through taking floating rate interest rate exposure. And the final area is Chinese renminbi bonds, a long-standing conviction of ours, but that generally performs very well during periods of heightened volatility. So another good place to hunker down. So that's the sort of way that we're looking at this environment today.
Within equities, which are your preferred areas?
So we started out the year at the global level looking at US, Europe and Japan. We cut the the US overweight at the beginning of the year in February, but we're still overweight Europe and Japanese equities on a currency hedge basis. We see no reasons to change that. If you look at earnings revisions, they're positive for both regions now. That's been the case for almost 2 years in Japan, but it's a relatively new phenomenon for Europe, so that's a positive factor that's coming through and continue. We expect those revisions to remain positive as we see the economies recover. Within Asia, we're a little bit more cautious on Asia. We talked about at the beginning of the year Asia being a year of two halves, so a strong first half ahead of the Fed rate hike, a more challenging second half. I think we still generally stick to that. Areas that we expect to be more resilient within Asia. China obviously is a very key focus for people. We're still bullish on those markets. We prefer the offshore H-share market. A-shares are likely to go up in our opinion on a central scenario basis, but volatility is going to be very high. We're seeing a lot of IPOs coming to the market. That could short-term depress valuations, but we prefer the H-share market. The other market we like is, I suppose, it's in line with our preference for global technology sector, and that we're overweight Taiwan as well within Asia.
You have not mentioned the outlook for the US dollar. You started the year bullish, which seemed to have worked out well. Do you expect the US dollar to gain more ground in second half?
Yes, we do, is the bottom line. I think, from our perspective, if you look at the performance over the first half, you've seen very strong gains initially. Then you saw interest rate differentials actually narrow somewhat with very sharp increase in yields in Europe, for instance, and obviously some soft data coming out of the States in Q1 depressing yields there. So we saw that interest rate differential narrow a little bit, but we're expecting that to widen. So we see the ECB actually accelerating quantitative easing, so that should cap any rise in yields in Europe, whereas we see the Fed obviously embarking on a Fed rate at its first rate hike. So that should allow interest rate differentials to widen once again, and that should push the dollar higher, maybe even 5 to 10% in the second half of this year. So been pretty weak in recent times, but we see this as a good opportunity to reduce exposure to non-US dollar currencies.
Thank you, Steve. We'll see you again next month.
Thank you.